In terms of the earnings outlook, I don't think the budget's changed much. But Nikunj, we must remember that the budget is for the people of India at large and for the economy, and it can't necessarily focus over the short term on either the corporate sector or the equity markets. So I guess the government has a different agenda, and the markets perhaps went in with very high expectations, expecting the markets to be the focus of the budget, and that did not happen.
But has the budget made a serious case for Reserve Bank of India to cut rates? Have they laid a very strong foundation with getting some fiscal discipline back?
I would think so. I think, the central bank has been saying for some time now that, growth is going meaningfully below the potential trend level. And I think we're getting some joy on the inflation side also. So all this does imply that, there is scope for cutting.
If Reserve Bank of India does a 25 or 19th of March, will that surprise you? Will that surprise markets?
I don't think so. I think a 25 basis point rate cut on March 19th is very much priced in at this point in time. It's very much part of the expectation subset of investors. Yes, anything more than that perhaps would surprise markets positively.
Post-budget, the bond yields have reversed. The bond yields have gone up and rupee has come down. Are macros looking bad now?
I don't think, see, the budget doesn't change the macros in just one stroke of a pen. So I guess, the macro has been stretched for some time. And I guess it's not going to change in a hurry. And that's something the financial markets will have to contend with.
But are macros looking bad?
I think the macros are looking stretched. There is no denying the fact that, both the deficits are very, very stretched. We don't need them at these levels. Growth is seriously challenged. I think the street is underestimating the extent of the growth slowdown. So it's not a very good combination to have at this point.
Many experts are also of the view that the GDP number which came out for the quarter gone by of sub 5%, that will mark as an absolute bottom for Indian economy.
It could mark a bottom. I wouldn't dispute that. But I guess the issue is we're probably in for a U-shaped recovery rather than a V-shaped recovery. So, I'm not one of those who thinks that, we're going back to 6.5 or 7% in a hurry. Probably, we hang around 4.5 to 5% for another quarter or two, and then gradually make our way up to somewhere between 5 and 6%. But so it seems to say, our opinion is that, we're probably in for a U-shaped recovery rather than for a V-shaped recovery.
At a time when earnings are contracting, do you expect that this year Indian markets are unlikely to generate positive return because your Sensex target is sub 18,000?
Yeah, I think, our sense is that near term the market perhaps on the Sensex, goes down to somewhere between 17 and 18,000. And that's really premised on the fact that current earnings expectations seem very high to us. The street estimates right now are for about 16% earnings growth. For an economy growing at about 5 to 6%, we think that's a little far-fetched. I think we'd be more comfortable with earnings growth in the region of about 10%, and we think the markets need to adjust to that.
So you are not of the view that earning expectations or EPS estimates for FY14, they need to be upgraded. You are of the view that they will get downgraded before you would like to revise them.
I think they will get downgraded because, as I said, 16% is a number which is fairly challenging in the backdrop of the macro that we have right now. For starters, the budget has imposed a surcharge on corporate profits. That itself will shave off about 1.5% in earnings growth. And then I guess, the earnings growth numbers, I think, are more geared towards a GDP growth in the region of 6.5 to 7%. Whereas, I think perhaps we'll perhaps end up at 5.5, 6% for next year. So I do think there is downside out there.
So do you think Indian markets currently are stuck between rock and hard surface? One side you've got the consumption cycle, which is slowing down. On the other side, you've got the investment cycle, which is yet to pick up.
Well, I guess, you're partially right in the sense that, it is a difficult environment. It's a challenging environment. To be fair to the government, a lot of initiatives have been seeded. But these initiatives are going to take some time to fructify. And perhaps second half of the year is when, we really start seeing the benefits of these initiatives. But over the interim, the market will have to contend with weak economic data. And that's something it's not going to like, particularly in the backdrop of the expectations that are there right now.
Closer to 18,000 on the index, you would be a buyer.
I don't know, because, markets can get cheap and remain cheap for a long time. So I guess, it depends on how the macro responds to the initiatives that the government has put through. But yeah, we are hopeful that, a number of initiatives have been taken, they've been seeded. And if they start bearing fruit, then who knows? Yes, it would be time to get positive.
If global liquidity is sloshing around, global liquidity eventually would like to chase winners and performers. No one wants to associate with a laggard, or no one wants to associate with underperforming market.
I hope not, because I think outflows would be a very challenging situation, because I guess it's not just the vulnerability of the markets itself to the outflows. It's the vulnerability of the entire economy because of the high current account deficit that we run. and the fact that we bridge that current account largely through capital flows, particularly portfolio flows. So I hope not. Again, I don't think there is a case for huge outflows, because first and foremost, as you rightly mentioned, central banks all over the world are running very easy monetary policy, and we don't see that changing in a hurry. So liquidity is going to remain benign. That's a core underlying assumption that we're making. Secondly, to be fair to the government, it's done a fair bit in the last 6-7 months. And so there's no reason for investors to really vote with their feet in terms of running away from the market. I mean, there's nothing structurally wrong. If anything, things have got better in the last 6 months than they've been for a while. So I don't see I don't see the need for substantial outflows. But yes, what I'm worried about is if the momentum of flows starts slackening, it can have an impact on the currency, because let's face it, our economy is getting bigger, the current account is getting bigger. So we need more flows to bridge the gap.
Do you think currently there is deep value in industrials, because the investment cycle eventually will pick up? And if I look at the large cap industrial names, stroke the machinery names, BHEL, L&T, Crompton, Grieve, things are looking smashed there.
Well, there is deep value in across the investment cycle. It's not just the capital goods manufacturers. I mean, even if you look at the infrastructure names, I think there is deep value across the investment space. The only issue I have with this space is it's cheap, and it could probably remain cheap for a while, because it's difficult to see the investment cycle picking up in a tearing hurry. If you look at the private sector, gearing levels are at 15-year highs. Monetary transmission is going to take some time to work its way through the system, and I guess there are limited stimuli available. So I guess it's a very exciting space if you have a 3-year time frame in mind, or even a 2-year time frame in mind. But on a 6-month basis, still looks challenged.
If I map the performance for this year for the Nifty, it's clearly IT all the way. Infosys, TCS, HCL Technologies. Now, the big tailwind for IT is currency, and globally it is hopes that American economy will recover. But in the near term, do you think IT will continue to outperform because we are in a messy environment?
I think IT will continue to outperform. We've been, buyers of IT stocks since December. We've been overweight the sector, and 2 or 3 reasons really. One is, as you rightly mentioned, the outlook for IT spending is definitely picking up, and we expect one more leg up into the second half of this year. Valuations have not been very demanding. The currency is definitely a tailwind, though I wouldn't ascribe a very high multiple to the excess earnings you get out of currency depreciation, and it's been a very underowned sector. So in that sense, even as investors rebalance their portfolios in favor of this sector, that's going to lead to some froth, but that's the nature of the game.
What are your thoughts on autos? Because Street is pretty much divided on how to approach autos. The bulls would argue rates will come back, demand will also make a comeback. The bears would argue that auto stocks are expensive, wage inflation has gone up, and the competition only will intensify going forward.
See, we are underweight on the auto sector at this point in time. If anything, I think we went negative on the sector a little too early, but we're thankful that finally the call's beginning to play out. As far as autos is concerned, I guess the key headwind for the sector is that cost of ownership is going up very meaningfully, because inflation's remained high for a period now. Interest rates are on the margin coming off, but they're nowhere near the lows we saw a few years back when demand was very healthy. Fuel prices have gone up very, very significantly.